All right, thank you, everybody. Let's do some housekeeping real quick. I'm Todd Phillips, CFO, Minnesota Real Estate Journal, former attorney, accountant, CPA. So the finance stuff is sort of in my backyard. So Jeff asked me to moderate this morning's panels, so I'll do that. But before we get started with the CE portion, thank you to everyone who came for our breakfast and networking. Started a little bit later this morning, and I noticed a lot of people came plenty early. So thank you to the people who sponsored our breakfast: Monroe Moxness, Wipfli, Jeff Peterson, First American Exchange, Irvine Advisors, and NAI Legacy. Thank you to those guys. You're no longer CPEC, Jeff, you're just Jeff Peterson. So for continuing education this morning, if you're getting CE credits, make sure you sign in and sign out. We have to be very diligent about the time that you sign in and the time that you sign out. So you have to be signed in by 8:30. We're recommending in the wintertime, if you come to these events, get here half hour early so you can make sure you're signed in. And then you have to stay the entire time. Also, the Department of Commerce is being a little bit picky about people hanging out in the hallways. So make sure that you're in this room when there's content going on. So when there's a break, you can feel free to spend time in the hallways, but as long as there's content going on, you're getting CE credit, make sure you stay here. Thank you for your attention to that. I do have to read then the following announcement. Today's event has been approved for 2 hours of continuing education real estate credits by the Minnesota Commissioner of Commerce and the Minnesota Department of Commerce. That is it for our housekeeping. So let's start. Yes, sir. Well, I'm supposed to be the hall monitor, so I'm watching you, Hogue. All right, the first panel, thank you for coming up. We have two amazing panels this morning. We are going to try to deliver 4 hours worth of content in 2 hours today. I guarantee you, if you can stick with us and pay attention for 2 hours, we're gonna have 4 hours of jam-packed content into two. So this first panel is important updates for tax-deferred transactions. Our three experts today, I'm gonna let them talk about what they do at their company and who they are, but we've got Dan Werry, Dannielle Lewis, and Jeff Peterson. I will try to say all kinds of good things about them as they mix in what they're saying, but I'm gonna let you do your intro. Are you okay with that? So Dannielle, I'll have you go first.
Sure. Good morning, everyone. I'm Dannielle Lewis. I'm a tax partner at Wipfli. Wipfli is a CPA firm, and we specialize in real estate and real estate type transactions. I've done many 1031 exchanges and other deferred tax exchanges, so I'm excited to talk with you guys this morning.
Good morning. My name is Dan Werry. My company is Irvine Advisors, and had plenty of experience and opportunity to work with Jeff Peterson over the years. As a matter of fact, about 23 years ago when I joined the industry, had lunch with Jeff and really got a good introduction to the business. So since then, I've been working with clients trying to place assets into tax-deferred 1031 transactions, so DSTs. That years ago, that was structured as a TIC. And then in addition, we support our clients with growth and income funds, all different types of assets, generally real estate, but some energy as well.
Morning. Hello.
Yeah, maybe we'll trade out that mic.
Morning, I'm Jeff Peterson, and I am a humble administrator of 1031 exchanges. I own and operate a company called Commercial Partner Exchange Company, which has been in business since 1998. And I also am an adjunct tax professor at William Mitchell, now called Mitchell Hamlin Law School. And I am very happy to be able to train the next generation of tax attorneys and inculcate into them some of the entrepreneurial and capitalist philosophies that I have. So that's what I'm about. Thanks.
I think for those of you who don't know these three people or are new to this industry, if you've been around and done 1031s, you know all three of these people. They are my go-to people when I have a question or when somebody calls me and asks for something complicated. I can't think of the number of times Dan and Jeff or Dannielle and I have had long conversations about whether how a transaction works and how it best fits together. That microphone wants to just keep dipping down on you, doesn't it? Okay, so let's get started talking about the content. One of the things we have to talk about is maybe not a hot topic, but our first item up for bid is 1031 legislation. I think, Peterson, you might say we've dodged a bullet for a little while, but what is the latest and greatest on what's going on with the legislature and tax law?
I just finished out my term as the president of the Federation of Exchange Accommodators, the National Trade Association for Qualified Intermediaries. And so I've been communicating with our lobbyists, working with the Real Estate Roundtable, and we feel very confident that we have dodged the bullet for maybe the next 2 years. But with the House now being controlled by the Republicans, the likelihood of budget reconciliation being used to push some tax changes through is probably reduced significantly. So we feel like we've got a 2-year reprieve, but that doesn't mean that we don't still have a target on our back. And we need to be vigilant. We need to keep our messaging consistent, that 1031 serves an important function to allow capital to move freely in the economy, to stimulate growth, keep property values up, and create private infrastructure, which is very important for economic growth.
Dannielle, what about the other targets that are out there? Carried interest, bonus depreciation, opportunity zones. What are some of the other things that we should be thinking about?
Hey, Todd, just before we go there,
ahead.
how many in the audience have completed a 1031 exchange in the past? So a majority. Do you keep an eye on the legislation when it becomes an issue for either campaigning or ways to hopefully support the budget? Is it as sensitive to you as it might be to the other industry professionals? Anybody? Okay, so it seems to be we're all pretty focused on this, and not sure if it's been a political component. Is it mainly just to get attention from their constituents, or is it something really to help balance the budget? But my personal perspective is that many of the senators these days realize that, hey, I own highly appreciated real estate. Why would I potentially take away an opportunity for myself to pass on their assets? But it's interesting. I don't think over the last 20 plus years, I think I've gone through that same situation maybe 4 to 5 times at least, where it becomes a real sensitive topic.
Yeah, it's hopefully we've, like Jeff said, we've dodged a bullet. Let's make the most of the next 2 years before we have to start campaigning again. All right, so Dannielle, back to you. The other kind of targets that the real estate industry has.
Yeah, I think for this year, we're kind of looking at whether or not opportunity zones will be extended into the future. That being, currently they're set to expire December 31st, 2026. So there's some extension bills to extend that to 2028, as long as kind of extending out some of the benefits that have expired for current existing people who are investing in an opportunity zone, to extend that a little further. There's currently a lot of good feeling that that might actually get passed and move into this coming year, but we'll see if it actually does and which components of it do. As far as bonus depreciation, is currently set to start sunsetting as of 1/1/2023. So instead of 100% bonus depreciation that we've been taking for the last few years, it'll move down to 80%. That's going to be a big change for a lot of people, because I think a lot of people are used to just now writing off most of their purchases. So whether or not that is a big change in people's businesses was something that, we all had kind of discussed on our prep call, as people are kind of used to just writing off that new asset from year to year.
Well, I think when they took away personal property exchanges, right, Jeff? Airplanes, things like that, trucks became a panic moment for industry because they've been 1031ing for decades. So the bonus depreciation was simply a replacement for that. So we could still kind of do the same thing if we sold an airplane and bought a new airplane. Bonus depreciation at least allowed us to be in a similar tax situation of doing the 1031. But now with bonus depreciation sunsets, we could be in a situation where, and it applies to us in real estate because of the personal property that's in our real property, but it applies on a broader scale everywhere. Like if bonus depreciation truly does go away, I think we're gonna see some people start to panic, wouldn't you agree?
I think there's a chance that there will be a resurgence and a call for personal property exchanges to come back into the code at some point, because if you don't have that offsetting deduction for new acquisitions, people are going to get locked into their stuff and not want to sell this low basis property that still has residual value, even though they'd like to transition to some other different kind of equipment that would be better for their business. The tax implications will prevent them. So we'll see. Personal property exchanges and personal property exchange programs had a real role in stimulating economic growth. We'll see if that comes back in the future. Or perhaps they'll just extend bonus depreciation as an alternative.
And then the last piece, I'm sorry, Dannielle, is carried interest. So if you're a real estate person in the room who took a piece of the deal and you were hoping that that would get capital gains treatment, that's been on the table for a while to pull that rug out from under us.
Yep, I think that's another item that we've kind of dodged the bullet on for right now as well. So carried interest as it exists right now still kind of has a loophole, so to speak, for real estate type transactions. So as long as you have a carried interest and you're selling the real estate, not the interest, the capital interest itself, you can kind of still be excluded from a lot of these rules. So that still exists, and we're not likely to see that change probably for the next couple of years as well.
So that's the high level overview of some of the bullet points I have. I'm hoping now that, that we have a sophistication level in the room, and we're gonna put this video on YouTube, of people that we can dig into maybe some issues, like dig into the weeds a little bit about some things that are causing people consternation. I think Jeff Peterson on our prep call put it perfectly that, you know, there's 3 or 4 really hot button issues that seem to come up over and over again. But the first one I want to dig into is just talk about strategies for low basis properties. So if you're somebody in this room and you've depreciated the heck out of a property and now you're wondering, what do I do with it? There's some options out there as long as you plan in advance, right? If you're selling it tomorrow, we might be in a bit of a panic. But if you have some time on it and you're starting to ponder right now what you might do with low basis properties, Jeff, you had one of my favorite strategies. We're going to walk through that and then we can talk about other ideas.
Well, you know, this is a panel about single tenant, triple net lease properties to some degree. And one of the best purchasers for single tenant, triple net right now is someone that is fat with equity, lots and lots of cash, doesn't need to put debt on if they don't need to, don't want to. And for people that are making emotional decisions, they're disgruntled property owners. They may own management intensive multifamily in Minneapolis or St. Paul, and they're fed up with regulations, they're fed up with rent control and eviction moratoriums, and just they're tired. They're looking at triple net as a safe place to go where they can still defer their taxes. They're using triple net as a place where they can go to avoid the regulation, avoid the management intensive responsibilities of multifamily. But they have this very low basis. They can't afford not to do an exchange. They have to go into real estate. Triple net lease, single tenant is attractive to them because they retain the control. They decide if they want to sell. They decide if they want to refinance. And for people that have low basis and lots of equity, that's probably your perfect candidate to market single tenant, triple net lease properties to right now. So one strategy that we discussed was exchanging into real estate that you could lever up now or lever up in the future in a separate subsequent transaction to get liquidity later on down the line, maybe when interest rates come down again.
Jeff, the only description you missed is that same person who's also frustrated with the tenants and local legislation is also looking to move to Florida.
Yeah, and I think they want that triple net lease in a sunny, tax-friendly state And I was told that Utah may add to the list of sunny tax-friendly states that don't have personal income tax in 2023. We'll see if that comes to pass, but Wyoming, South Dakota, Florida, Tennessee, states that are more, I guess, tax-friendly are definitely attractive. And if you're worried about dying and leaving your real estate in a state that has inheritance tax, that's also a factor that comes into that equation. So thank you, Dan, for that.
Yeah, I mean, don't die in Minnesota. Just saying. It's bad for your tax bill. Dannielle, so if somebody approaches you with a bunch of low basis property, what are some of the strategies that you walk through with people?
Well, on my side, I don't really have any products to offer them. Typically speaking, you know, we kind of go through, hey, this is what the gain calculation looks like. This is what it would look like if you were to do a 1031 exchange, which is usually our first approach if we can kind of do it and if we're ahead of the schedule. What typically happens is someone comes to us 2 days before the sale and are with this low basis issue trying to figure out what to do because they have this big gain coming up. In that situation, it becomes a little more difficult because we don't have enough time to really plan ahead. So we've usually got to look at something like an opportunity zone fund or something like that to defer the gain into. But traditionally speaking, yeah, if we have enough time to plan ahead, we can either refer them to other kind of partners that we work with that can help them find a product. Say if they're looking to not maybe divest from what their current portfolio is, retire a little bit, not manage properties one-on-one, you know, connect them with a DST provider, that sort of thing.
Do you ever talk about installment sales or do you save that for business sales?
Installment sales with a 1031 exchange is quite complicated. So I typically try to avoid them because it's hard to really get all the components in place. So it's whether or not it's cost effective for us, the lawyers, and everyone else to kind of get involved to still do the installment sale. But I do have a few that exist, and it's another deferment strategy where depending on what the installment sale is, they're either going to, you know, defer part of it through a 1031 exchange and part of it through the note.
And what do you see in terms of estate planning or family transfers as low basis properties?
Like as far as related
Do you
party?
want to get it out of your estate or keep it in your estate so you get a step up in basis? What are some of the plays there?
Well, kind of depends on your overall portfolio. You know, I think, Jeff, your motto is exchange, 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 die.
Defer, 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 die.
Yep.
That's been copyrighted.
So I think that's one strategy that people can have. I think it depends on, you know, what the next generation wants to do with it as well. I think that's part of the conversation to have with people. Because most of the time we're going to see the next generation is just going to sell the property, divest whatever was there. And so that approach works really well because then they have the step up in basis and shouldn't have a big gain. It is stuck in the estate though. So depending upon what their overall exclusion is, right now we're still looking at a pretty hefty exclusion for most people when they pass away. So it's still kind of beneficial to kind of keep those items in their estate. So unfortunately, it's a lot of tax planning. We're actually doing a lot of that now with our clients to ensure that they're kind of utilizing that really big exemption to the extent that they can now. So some of these have moved out of their estate depending upon what the overall tax benefit would be for them.
Right, that's what I've seen is people moving it out of their estate, which means no step up in basis, which means you weren't listening to Mr. Peterson. So now you're talking about the next generation. I think of depreciation as like a physical thing, like this, it's basis. This is my basis. And once I'm out of basis, how do I create more basis? Because if I'm the next generation or if I'm the current owner, all of a sudden, when you have no basis left and no depreciation on your schedule of real estate owned, that gets really expensive. The tax bill gets higher and higher. So if you listen to me when I was in my 20s, and we were saying, do cost segregation studies, do all this stuff, get all the depreciation you can. And now you're looking at it 10, 15 years later, and there's no depreciation left. It hurts. Every time you calculate your tax bill, it hurts. So how do we create more basis? And I think, Jeff, you and I talked, you know, do you exchange into something that you can lever up and create more basis?
I think my favorite strategy that I see really sharp investors, these are the investors that don't go 2 days before the sale to their meeting with the accountant. They're doing it 2 years in advance, and they're thinking ahead. And the coolest nifty trick is that normally when you buy raw land, dirt, you can't depreciate it, right? What you paid for it is stuck in that forever. But what people are doing is they're selling their fully depreciated apartment buildings, and they're taking that $2 million of equity and all of the deferred gain that's inside of that, and they're buying dirt. They're buying the raw land on which their next development will be constructed. So they're burying that gain in a non-depreciable asset, which is the niftiest trick of all. And then in a separate estate or like a three-dimensional chessboard, they're going to then later construct the improvements on top of that and have fresh basis on the improvements, which they'll be able to fully depreciate in the future. So that's what I think the best trick that I've seen is to bury it in the dirt, the non-depreciable 1250 dirt.
I would agree, because when you do that new construction, now you've got 100% depreciable asset instead of whatever percentage of the is a land building. So I think a good way to create some more future depreciation for the next generation.
The only unique aspect to that or challenge to that would be for going back to estate planning, and then you have older owners that are looking to stabilize, maybe head down to an area where they can play golf more frequently. And that's where the types of clients that we end up working with that are looking for more just passive income. So the Delaware Statutory Trust, 1031 type transaction, and or other assets as well. But I do agree that, as Jeff mentioned this on Monday, that is an excellent way to really grow your value. So if you're still in the game and you're active, that's the smartest real estate play you can imagine. Those that are looking for more estate planning, put it into something passive. The heirs are probably not going to be interested in managing it. That would be more like the passive income DST type transaction.
Yeah,
Definitely seen a huge increase in the last 2 years in people going into syndicated real estate, DSTs primarily, some tenant and common arrangements, but that's definitely a trend that's been hot. I think that as interest rates have increased, the attractiveness of the DSTs and of, just triple net lease in general has declined, because if I can get 4.5% in certificate of deposit or better in
corporate bonds.
why would I want to put all my cash into illiquid real estate? Well, I can tell you why, because of tax deferral 1031, but if you remove those elements, the attractiveness of having liquid cash in bonds or CDs that performs better it's a counterwind that's hard to fight. So I'll leave it at that.
Yeah, let's switch the narrative now from, we talked a lot about basis and everybody felt like I did in law school, like, please stop talking about basis, my head's gonna explode. And let's talk about cash out. So let's say your goal is a little different. You've got that low basis property that's been paid off and you're thinking about cash. Somebody once told me $1 borrowed is $1 earned. But I'm ching. But what are the options out there for all three of you? If somebody sees the opportunity to maybe get some cash out of a property, either before an exchange or after an exchange.
Well, I don't give people tax or legal advice, but I would be mindful that the IRS, at least 2 decades ago, was going after people that were doing pre-exchange refinances, taking equity out of their properties in anticipation of their sales. And the IRS's perspective was this is tantamount to taking cash boot at the time of the closing if you're levering up your relinquished property right before a sale. So pre-exchange refinances, I think, are a little bit more risky, although there are times when maybe it's necessary. If you have real estate that's owned in a corporation and you have stockholders inside of that corporation that are not exchange-minded and they want out, the pre-exchange refinance to redeem out those exiting non-exchange-minded stockholders may be the only way to affect the pre-exchange refi and get an exchange to go forward. because you have to deal with the dissenters before you can deal with the sale. But generally speaking, post-exchange refi is probably the better play, the safer play. Would you agree?
Yeah, and I think, Jeff, that's where buying the single tenant triple net makes it a little bit easier later to trade into and then pull out a loan as well. Now, I think the one challenge to that, unfortunately, with the corporation that wants to, or some want to exchange and others do not, those that want to exchange in the future then will need to match that debt on the future purchase. So, and these are unique situations that, Jeff, we've worked with clients over time, but then we'll need to just figure out a nice balance. And I have assets that have debt already in place. So then we can help those clients match that debt, and it's non-recourse, which is easier. So they don't have to worry about qualifying for a loan, putting it on their balance sheet.
One characteristic of DSTs has been that you can't refinance your beneficial interest in a DST. And that's why triple net leased single tenant was more attractive, because if you wanted to do post-exchange refis, you were in the driver's seat. You owned the fee title, you could refinance it. Whereas a DST share, you're kind of in the passenger seat, you don't get to call the shots. But Dan, there is just a small sliver of that DST syndication world that does offer a post-exchange refi. Could you speak to that?
And this is also something that was discussed previously, that there are certain companies, some of the largest in the country, as well as some that just specialize on this in this asset type class, where an exchanger can exchange into the DST. Now, there is a chance sometime in the future there may be a refinance that would occur in the future. It would pull out equity. So, and Dannielle mentioned this as well the other day. That's something you do not want to have as a part of the pre-initial decision making or marketing of that investment.
Yeah, I think when we're looking at either of these situations, pre or post refi, facts and circumstances are really going to be a huge play in there, but a big part of it is going to be the business reason and the business case that you have of why you needed to do that debt refi. Especially in this situation, the DST, that would make me fairly uncomfortable. I would need to know a lot more details about why it's happening. Was it part of the original kind of PPM offering memorandum type thing? So I think a lot of these are very facts and circumstances based, but I generally agree that a pre-refi is going to look a lot worse than a post-refi.
You mean wanting to buy a Ferrari is not a business reason? I don't understand.
Unfortunately
Jeff,
not.
or Todd is speaking
Intermittent
from
rentals.
experience.
What is that site, the Turo? I'm gonna lease that Ferrari. I'm going to repeat the question because it's being recorded, and that is, why is this such a big deal? Why does the IRS care if you're refinancing your property? And I think it goes back, Michael, to the old rationale for 1031 is that we're not going to spank this taxpayer because they're not cashing out. They're simply continuing their investment into property of equivalent or greater value and equivalent or greater equity. So if there's cash coming out right before the sale, it looks like you're cashing out. I mean, probably you are.
Mm-hmm.
So the policy is the incentive to keep your money invested into real estate. So if you're taking equity out, then technically you're not maintaining that ownership structure.
But there's a debate all the time on Phillips, especially on Phillips. How long do you have to wait? Is it 1 year? Is it 2 years? Is it next tax season? Is it 5 minutes later? Can you address that?
The question from the audience is, well, why does it matter as less in a post-exchange context? Why does it matter less?
And how long do you need to wait?
And how long do you have to wait? And I think some tax commentators say that, look, if you buy a single tenant triple net lease property, you can receive your income consistently and steadily over the course of its investment in small, consistent, and reliable increments, or you can refinance the property and receive that same income in a more accelerated fashion, and then use the rents to pay down the debt. It's the same income, It's whether you want to take it up front or take it over time. And so I think there's less concern with the post-exchange refi. Doesn't look as suspicious because you're just taking the revenue that you would otherwise be entitled to receive in the future. I don't know, is that a justification without a difference? Maybe, but the IRS definitely does not like pre-exchange refinances because they think it's tantamount to taking the cash in the closing statement.
Yeah, and I think of like one example, someone just asked me this blank question one day, and what they wanted to do was do a post refi and then cash out one of their partners 3 days later. Like that's going to look a lot more suspicious of a post refi than just, waiting a year, and for business purposes, you had a better rate, something like that, to do a cash refi out.
Well, I'm glad you guys brought up the next big topic, I think, that gets missed, not talked about enough, that's important to consider in 1031 net lease transactions is partnerships. So a lot of properties, and I think somebody once told me, if you drive around the Twin Cities Metro and you notice every building, there's somebody that owns that with a tax problem. And usually it's more than one somebody. And so those are owned in partnership or LLC or whatever formation they are. And different partners have different ideas of what they want to do when you come to the end of the line. So what are some of the favorite strategies right now, and what are some of the pitfalls to avoid? And I think I'll start with the first pitfall. Don't sit in the front row and say, I'm closing tomorrow and I would like to split up my partnership. But go ahead, let's start with, Dannielle, you want to go first?
Sure. This is a problem that we come across pretty often. Something where I think a lot of us are kind of changing even like how we approach partnerships that have real estate, and maybe the relationships or dynamics among the owners have changed over their years, or we anticipate there going to be a change in what they want to do with that property, and trying to drop them into a tenant in common years before they might have to actually do a 1031 exchange, just so they have that flexibility in the future to kind of do what they want with it.
And just so we're all in the same vernacular, I'm sorry to interrupt you. When you say partnership, it could be an LLC, it could be an LLP, it could be a partnership entity, but you can't exchange partnership shares, like you can't exchange stock shares. Even though the partnership owns real estate, you can't exchange those. You have to get the real estate out of the partnership first to do a 1031 exchange, right? Okay.
Correct, yeah.
So you're saying if we take that out and make it tenant in common interest or DST interest, now we have something we can exchange.
Correct.
Okay.
Yep. Thank you for that clarification. Yeah, a partnership interest would not be real property. In a 1031 exchange, you can only do real to real property. So that's why you drop it into a tenant in common, because now each partner has their own each former partner now has their own fractional share of that property and are able to do what they'd like with it. So that's one thing that we've been trying to maybe shift the conversation to, is really pre-plan. So it's not a year out. So we've got plenty of time to kind of work through these different options. We do see still a lot of the last minute drop in swaps. So when you are taking that building, dropping it down to that tenant in common interest, and then people either wanting to be part of the 1031 exchange or people wanting to be bought out. Those transactions are going to be typically a riskier type of transaction to do, and it's going to be a lot of facts and circumstances based on whether or not your tax advisor, lawyer, whatever would deem that to be a respected transaction in the eyes of the IRS. So
yeah, so you'd be okay with the drop and swap if you planned it well in advance, right? And it was part of a bigger overall plan, and it wasn't a partnership anymore for some tax period of time?
Yeah, and it's whether or not probably you'd even really use the term drop and swap, depending upon how much time it would be. But yeah, I mean, there are ways you can kind of reorganize.
I think, Todd, you would call it a drop, substantial hold, and swap. But there are other mechanisms that I think Dannielle was alluding to, like the 708 spinoff, where you could spin a partnership off into one or more subsidiaries that are considered continuations of the predecessor and have less risk on a holding period or qualified use argument. So 708 spinoffs are a nifty alternative to just crudely dropping and swapping. And then I'll say that there are some investors here in the Twin Cities that are using outside money, hedge fund money, to come in with them. And they're not forming partnerships. They're specifically setting them up as TICs, tenant common arrangements. So the hedge fund has its own entity and the local investor has their entity and they own it as tenants in common from the get-go. They're setting the stage for the eventual sale and the elegant, disposition so that they don't have to worry about not being able to exchange in a partnership interest. So there's people that are thinking ahead. And then one final thought. The trivia question is, when can a partnership interest be exchanged? It's when you're buying out and consolidating 100% of a partnership in one single taxpayer. So we have some clients that are using 1031 money to buy out all of the other partners in another deal to consolidate 100% ownership in that one exchangor. And that's a really nifty strategy that can be used to then clean up properties and get rid of the minority purchasers that came in with you initially.
Can you explain the 708? Was that the name of the bar napkin that you drew it up on, or what is it, 708 again?
That's the partnership code sections in the Internal Revenue that deal with partnerships. And in a 708, we might have the Jeff and Dan partnership. And if he wants to go off and do an exchange and I don't want to do an exchange, we don't have a problem. We just tick out the non-exchange minded person and let Dan keep the old entity with his spouse in it, maybe as so it continues as a partnership. But if both Jeff and Dan want to do exchanges, but we don't want to do them together, then a 708 spinoff would be where we create a new LLC that's 99% owned by Jeff, 1% owned by Dan. It's still got the same two partners in it. It's just that the economics have been weighted heavily on Jeff. And the heavily Jeff entity can do an exchange with Jeff's portion of the proceeds. Meanwhile, the old entity is now owned 99% by Dan, 1% owned by Jeff. It's going to do an exchange with Dan's portion of the money, and economically, Dan's basically doing that exchange. So a 708 does not give you a full and complete clean break with your old partner or partners. But what it does give you is a more defensible exchange because you don't have a holding period concern. The facts and circumstances are better in a situation where both entities are considered continuations of the predecessor after the spinoff.
So Jeff, similar to what Dannielle was saying, do you need to season that as well? Or is that something that can be
No.
done just before the sale?
I think it can be done before.
All right, that's fun. How many people have glazed over at this point? We're all up here geeking out. This is totally enjoyable. Okay, let's talk about UPREITs and other strategies like that. I know Dan and all of you have probably seen some UPREIT transactions lately. They've become back in favor again. Is that a way to maybe think about moving your portfolio on to as you move on and retire and things like that? So how does an UPREIT work, and what are you seeing in the marketplace?
So initially, a large REIT would have been structured, and then they would go out and try to buy assets, and then they would go to the owner and say, would you like to UPREIT? So a 721 UPREIT transaction, tax deferred as well. And then that owner can now get some diversification and more passive income management structure goes along with it.
Is the owner contributing their property to the UPREIT immediately? Is that what's going on?
That was the primary process. And then I know that there's a sponsor in the cities that had a private REIT, that's what the structure is that they were providing mainly regional clients here. Now that has gravitated towards our industry, especially over the last 10 years, where large institutional buyers, sponsor companies nationally will put together assets in a REIT, and then they'll let clients do their exchange and then UPREIT into, or excuse me, they'll invest into a DST, and then anywhere between 2 months to 2 years, that DST interest will then get pulled into the REIT. So it's interesting that time frame can be as short as 2 months I've seen, but as long as 2 years. And in some cases, those investors would have to transfer into the REIT or take another 1031 buyout option if they'd like. In some cases, it's a mandatory 721 UPREIT, and in other cases, it's optional. So depending on what a client's interests are and flexibility that they're looking for, maybe they just want to park that cash for a short period of time, and 2 years is generally pretty short. Well, here's an option that they can look at a transaction that's going to happen in 24 months. But generally, UPREIT means you get more diversification, shares of in a REIT, so now you have stock ownership. So if you do sell at that point, you would have a pro rata capital gain tax to pay at that point.
I love the UPREIT conversion after a DST if the REIT is full of really good real estate. But if you're just getting UPREITed into a pool of junk, then it's not so great. So I think you got to look at the historical return and the other components that are inside of that REIT before you commit to a DST that has an UPREIT conversion that's going to happen in 2 years. But when you die, if you want your heirs to be miserable, give your heirs an apartment building for them to co-own together. That will cause more family rancor and discord. And from the grave, you can continue to torment your relatives. But if you want to be nice, UPREIT into a REIT. And then when you die, now you've got nice divisible REIT shares. Bobby can get 13 REIT shares and Susie can get 13 REIT shares, and you can have a very divisible asset or estate that's easy to divvy up. I think from an estate planning perspective, it's a really nifty tool to give your kids the step up in basis and not have to be interconnected with each other in common ownership of real estate.
Dannielle, I hear people say, I'm going to 1031 into a REIT, and I know that's like fingernails on a chalkboard for you and I, but what are the correct terms and what is the correct methodology so that when we say it now, we can say it the right way?
Yeah, it kind of depends on the transaction because Dan kind of described 2 different ways that you can kind of get into that REIT. Typically speaking, and this is an area that a lot of people I think kind of get confused on, depending on this REIT situation, you're going to contribute your property to an underlying entity probably that the REIT owns. That could be one structure. I have seen it before where I think, Dan, this is what you were describing, is the REIT has property, you 1031 into a fractional share, and then at some point you contribute it up into the REIT. So that's another way, but typically speaking, we're gonna do something where we're contributing our property under tax code 721, which is typically tax-free. I'm gonna say typically and generally because there are situations when you do an UPREIT type situation, it could be a taxable problem if you have basis issues, back to our boring basis topic. But if you've got a negative basis in your property, or really low basis, and you've got really highly debt leverage property, you're contributing that into your REIT. Now your portion of that debt that you used to have is now spread among all the other people in that UPREIT structure. You could have debt relief in that situation. So we've actually come across that a lot with people with highly leveraged property contributing them in and not actually having the basis to do it.
You could have problems if you do a post-exchange refi, as Michael was talking about, after a 721 contribution, because it looks like a disguised sale if you distribute cash out too. So there's all kinds of landmines around that contribution. And then I noticed, Dannielle, that you said after some period of time you can contribute it to the REIT. I was up in North Dakota and someone asked the question, can somebody buy a tenant in common interest in a development and immediately contribute it to a REIT? And I gave the lawyerly answer that it depends, and probably you want to hold that real estate interest for a substantial period of time before contributing it to the REIT, because you want to season that replacement property to satisfy your 1031 exchange. And this scrawny little guy from St. Paul nearly got ridden out of North Dakota on a rail. They did not like that answer because they had been doing these immediate contributions to the REIT for so long that they assumed that that was just the proper way to do it. But I believe you have to hold your real estate for a period of time before you can eventually later contribute it up to the REIT in a partnership contribution. So you got to do it in stages.
Where do you get this information from? Is there a rule book that I can go down to the library? I mean, I'm thinking Christmas parties now, Michael, you got new terms, you can say 708, 721, in addition to 1031, 1245. There'll be a test later, by the way.
Actually, the other question with regard to that property, talking about this property that is probably a problem property, small apartment building, sick of it, they want to leave their kids, it's a problem. So is that an easy property to bring into an UPREIT situation when you have a REIT that's got a whole bunch of industrial properties that are high-end there's properties? I don't see them taking that property and say, oh yeah, UPREIT, because they don't want to do it.
It generally REITs, you want a homogeneous
We have to
asset
repeat the
class.
question for the audience.
So the question is, you've got an asset, so a local apartment building, maybe undesirable, pain in the rear, and owners want to get rid of it just because they're done with the management. And is that something that you can UPREIT into the REIT structure that we've just been discussing here? And in most cases, REITs are one asset class, so they might be all industrial or triple net, single tenant type properties. So the answer generally is no. Now, I do know of, again, a local sponsor, I'm not sure if they're still offering this, but they have had where you would say a multi-asset type REIT. There is a large, I would say international type sponsor, domestic, that does have multi-asset, but that's rare, and they only generally are institutional credit tenants.
I mean, I asked the question because I think that everybody in this room is like, oh, that sounds like a great thing, you should do that. And then when you look at what you're selling, it's probably not that great a property. Probably not going to do enough.
Yeah, I think Jeff was describing you don't want to pass your problems on to other people, and other people don't want those.
I think that, Michael, what probably happens is that you sell the pain in the rear property in an open market sale and put the proceeds into a 1031 exchange with your favorite qualified intermediary, and then identify the replacement property that the REIT sponsor wants you to acquire. And it'll be an asset that they've already teed up and curated for you to purchase. And then after you've held it for a substantial period of time, you contribute it to the REIT, and they will have orchestrated that for you. We did that for a guy that sold an industrial property in Rochester, bought a multifamily property in Woodbury, and then after 2 years, he was supposed to contribute it to the REIT. The problem is valuations changed in that 2-year period, and he decided not to contribute his curated interest to the REIT and wanted to continue to hold it, even though it had been completely orchestrated and set up for his benefit by the REIT. So a lot can happen in 2 years, and you may choose not to do the contribution.
In most cases, Michael, those are the types of clients that we work with, that we'll give them a menu of 30 different options. In most cases, 2 to 4 different assets would make sense for that particular client, and then they would make that transition. They'd work with their favorite QI, and then we would help them place their assets into an UPREIT structure.
I would just say, I am a qualified intermediary, but I'm not here as a salesman today to pitch my company. And there are a lot of great QIs and great people to work with in the industry as a whole.
Can the REIT do a 1031 after the fact?
Yes, they can.
So that might be safer?
Well, REITs have special concerns about their debt and long-term landmines. So yes, they do want to do exchanges because they don't want to trigger gains for their constituents.
Right.
And they want to make even more certain that they actually succeed in their exchanges, because the consequences of not succeeding can be very devastating for their constituents and investors.
All right, we've got 10 minutes. There's a couple things we got to cover because we said we would. Real quick one is one of our bullet points was on crowdfunding, but I think that's a broader term. We could talk all day about what do you mean by crowdfunding, but sourcing capital and some of those rules that, Dan, you have to sort of work with, because when you're moving properties in a 1031 exchange or buying net lease or doing those other things, if you have multiple investors, lots of times the SEC wants to get involved and consider things as security. So what sort of the marketplace right now look like in terms of those rules and laws, and what are people doing?
So when I think of crowdfunding, I think of, well, how are you accessing potential investors? And in most cases, many people think of the internet. So initially through the Jobs Act, I'm not sure if that was 4+ years ago or more, but the government laid out parameters on how you could work with investors through the internet. So established relationships, and how do you document that? In addition to that, it created lower investment amounts in order to do that, and then ceilings on the amount that you can raise through these unestablished relationships. So that's the crowdfunding. Now, that has since gravitated towards different types of sponsors and their marketing programs and what types of investments that they're choosing to invest in. In my case, I'm more sensitive to the relationship and what I need to do to substantiate that relationship. And it's a process of time, but also a certain amount of questions that you need to understand what's more important for a client and what their short and long-term goals are. And within that, then I can then open up those products that the clients are looking for. But mainly it's a structure question, but a relationship question. And then what is the client looking for as far as investments for me?
So for the people who haven't been through this process or had this discussion before, Dan, do you have a real estate license, or what kind of license do you have?
Previously had a real estate license. I'm licensed as a financial advisor. And like most of us on this panel, except for Dannielle, we're also a law degree, and then plenty of tax. So I thought one day I wanted a tax LLM, and I got an MBA, finance MBA instead.
We won't talk about how long ago that was when you and I had those discussions. But anyway, so the idea is just to be thoughtful about what type of interest you're talking about with your clients or for yourself, and make sure that you're in the right category. So if you're talking about DSTs, there may be a requirement that it's a security, and there may be laws around how that's offered and sold to you or sold to one of your clients. It's gotten a lot more flexible, when you say over the last 10 years, 20 years, than what it used to be. But there's still potential landmines, as Jeff would refer to, in a lot of these things. Okay, we've got 7 minutes left. I want to open it up to more questions other than Michael Hogue. Does anybody have anything to say? Oh, you're good. Hearing nothing. Okay, is there anything on the panel that we missed that we want to talk about?
I think we're going to be going into a recession. We need to batten down the hatches. I think we need to have lower expectations for at least through the next 2 years. And that is going to mean that there will be opportunities in real estate. Change is maybe a good thing. And one of the things that I think is most interesting is an observation that was made that when there is inflation and triple net leased properties are locked in at rather low rent escalators, you could have under market rents in these long-term leased properties that will create opportunities. What are your thoughts about that?
Yeah, I would agree. And I think you have to remember, to the theme of the day, that the person who owns that property that maybe has a below market lease also has a tax problem. So when you come in and you want to solve the rent problem as a real estate professional, or you want to repurpose a property, or get the tenant up to market rents, you've got to remember that you might have a landlord that needs a solution that Dannielle or Dan or Jeff might be able to provide because they don't want a gigantic tax bill to go along with the fact that maybe their property isn't worth what it once was, or other issues that you might have going into this recession.
I think another observation is that with rising interest rates, homeowners, people that want to become homeowners, are going to be priced out of home purchases because they can't afford to buy. They can't afford because their cost of funds is greater. That will allow multifamily owners to increase rents because there'll be more demand for people to stay in apartments. So I think that there will be some interesting outcomes from rising interest rates, and one of them may be increased cost of renting, which again may have more inflationary, may cause more. because the CPU, Consumer Price Index, and others, they look at rent, they look at food, they look at the cost of these items, and we may have higher perceived inflation because of that.
Yeah, and I would say that, as Jeff had mentioned, with the single-family residents being priced out for many potential buyers, and now rentals are an opportunity to move into as a source of need, but now you can increase rent. So that enables many investors to track inflation. So as rents are renewed and annualized every year, now you can increase your rent. So now that investment in the multifamily, you may be paying a higher price today, but you have an opportunity to grow the income. Whereas Jeff had mentioned a single tenant triple net may have a flat or fixed lease. So that may be capped at its value, at least currently.
And Dan, if you were developing single tenant triple net lease properties right now, you would find that the cost of buying the dirt, paying for the materials, paying for the labor, and all of the other costs of construction have increased maybe 10 to 15%. So it's going to be harder to develop new single tenant triple net lease properties in the next maybe 24 months. While demand for it may also be declining because other competing investments may be more attractive and have more liquidity. So it's going to be an interesting run, and that's going to cause opportunities. So keep your eyes open, but also batten down the hatches and be ready to ride out a rough patch if you have to.
I think the adage is, if you're going into an inflationary period, you want to buy hard assets, so real estate. So yes, developing may be more expensive, and it certainly is. That something that's already at main and main is going to go up in value, even though you may have some repairs that are going to need to be done or may need to be updated. But you put that money in, and now it's a great location, great investment.
I would make a caveat, in this particular type of inflation, I would want income producing real estate, not just raw land. I think you're going to do better with income attached to it. There is one thing I thought of, light bulb went off last recession. We were all friends back then. And I remember a couple panicked phone calls of people that were getting foreclosures that had really low basis. So what's the strategy for I'm not getting any cash out of this, but I'm gonna have a huge tax bill if this foreclosure goes through?
Debt relief is gross income, which is counterintuitive. And a lot of the ordinary run-of-the-mill investors don't understand why debt relief is gross income. But you could sell or involuntarily sell property, and your gain is not determined by how much proceeds or cash you get at the time of closing. The gain is determined by the difference between your adjusted basis and what you're perceived to have sold the property for, which is the amount of debt that's being extinguished at the time of the sale. And that may differ if it's recourse or non-recourse debt, but people during the last recession were doing exchanges on assets that they were getting no money from the sale of. They sometimes were bringing cash to the table to get rid of the property, and still they had to do an exchange because they had very low basis. So you may see people doing debt exchanges because they previously extracted all the equity out of the property with numerous prior refis, and now when they're doing the sale, they've got low basis and no proceeds.
There's a particular company that we work with that provides a solution for, generally it's corporations, but other high net worth investors, and for basically about 85, 86 cents on the dollar, you can trade all that debt that you need to cover up and then get out of the exchange either with a $0 cost or basis situation, or with nominal proceeds. You can at least extinguish that huge capital gain that you'd be paying.
Yeah, so if you yourself end up in that situation or see somebody in that situation, even bringing some cash to the table may be better than a huge tax liability. Maybe the lesser of two evils. Don't forget that that's an option that's out there.
Well, would you rather give 17 cents on the dollar to Inland to buy an interest in an Amazon distribution center, or give 35 cents on the dollar to the state and Fed on your debt relief? I'd
rather give
rather,
$1 million to inland than a red cent to the IRS, but that's just me.
well, in 10 years, that inland investment's going to be worth something.
Right.
And in 10 years, the money you paid in taxes won't be worth anything, right?
I remember the first time you said that to me, Jeff, I thought you said dead exchange, and I thought, well, both are equally appropriate. That's all the time we have. Let's thank this panel. If you have questions, they'll be here, I believe, throughout the next panel, so feel free to come up and ask. Let's get the next panel on stage and keep moving so we can get done in the 2 hours we promised you. Thank you, everybody. Okay, panel 2, moving on. I know I see some people getting coffee. Make yourself at home. But we're going to get started either way. Again, I'm going to let these folks introduce themselves. Hopefully that anybody in the room actually found our mobile app. We have one. I paid money to get it developed. It's complicated and hard, but nobody ever opens it. So eventually I'm going to take away your little paper and we're going to make you open up the mobile app. But the nice thing about it is if you want to know more about these speakers, you can go onto our mobile app. And there should be a QR code. Is there a QR code in there? So if you click the QR code, now you can learn more about our speakers. So if you want to find out, you want to connect with them on LinkedIn, you want to get their contact information, you want to connect with them, all of that's available on our mobile app. So that allows us to do a little less time talking about ourselves and focus on the content. But I'm just going to start at the end here. And Vicki, right, you're going to go first then, and just introduce yourself real quick. What I like to do, just tell us a little bit about who you are and what you do, but then like, what are you working on right now? What's top of mind? What's the most interesting thing in your world?
Good morning. I'm Vicki Lord Johnson. I'm an attorney at Monroe Moxnessburg. I specialize in commercial real estate, leasing, acquisition, sales, and development of commercial property. Our firm has Minnesota, obviously, and a national component with regard to multi-unit retail properties. So a lot of our work during COVID was lease negotiations with landlords in terms of trying to sustain and deal with that tension between needing rent relief and wanting to maintain obviously income coming into the landlords. And now we're into a period of time where we're working on new leases, new development of properties that have occurred during buildings that had occurred during COVID.
And then Pat Weller, if you don't know Pat, you haven't been coming to our events and there's something wrong with you.
Thank you. Pat Weller, and similar to Vicki, I am a shareholder at Monroe Moxnessburg. I've been doing the triple net properties since about 1988 when I first started to practice. My good friend Mike Diamond and I were talking to a mutual client, and we were recalling how some of the cap rates on the early FFCA leases were about 14. So things, things are cyclical, things change. So I went to the Restaurant Finance and Development Conference, which some of you may have gone to, or someone may be aware of. And I think to echo what Jeff said, I believe my take is there needs to be a managing of expectations. I think arguably in the last 12 to 24 months, there may have been irrational exuberance, to quote Alan Greenspan, in the market, in this 1031 market. But cap rates are going to go up because interest rates are going up, but there still are there's a fair amount of activity. And again, to echo what Jeff said, not nearly the activity that there had been in the past, but people are looking to look at unique ideas and ways to monetize some of their cash and look at the investments.
Okay, we're going to slide on down to Matt Hazelton. So as a person who lives near Hazelden, I will never, ever be able to get this straight. Hazelton and Hazelden, and do you play golf or you have a drinking problem?
I'm a terrible golfer, but I like beer. So not a frequenter of Hazelden. Right. At Hazelton, I work with JLL Capital Markets. My focus is on single tenant net lease properties and shopping centers. And I find for, the single tenant net lease product, the, 1031s, you can't do a deal without talking about a 1031 at least 17 times. And in shopping centers, we find that probably 60% of the transactions we do, at least one of the parties is doing a 1031 exchange. So I think it's pretty common throughout. It's kind of what just overarching theme, what we're looking at for next year. I think, to Jeff's point earlier, I think it's going to be a little bit slower. I mean, I don't know about anybody else in here, but it was kind of a welcome sigh of relief going into Thanksgiving, where it kind of felt like, you know what, I'm kind of okay with a little bit of a slowdown right now because the last 18 months has been pretty bonkers. So, but I don't know, I think, there's still deals going to be happening. I think it's just the low-hanging fruit of finding sellers that are purely price motivated. That's off the table now. And now you're kind of moving into, people selling, either they're merchant developers and they're just going to sell and they're going to, make sure their margins work, or just, investors that are going through those kind of life milestone changes.
Last but not least, Michael, the Chief Hogue, I'll let you do your own intro.
Can you, okay, this is working. First of all, I have to admit that I went to First Avenue last night and watched a show. So then I got home and I plowed, so I have no brain right now. But so no one could throw questions at me like I was doing to the earlier panel because I have no answers. Anyway, I'm with NEI Legacy. We're a part of the NEI Global Group out of New York. I think we have something like 300 offices or 350 offices with 5,000 professionals, and we're part of that group. And our particular company here in Minneapolis is a broker, just like Matt is. I guess I would consider us, friendly competitors. We do a lot of single tenant, triple net leases, or at least I do. I've been doing those for much longer than Pat even mentioned. In fact, she kind of stole my thunder. I was gonna say that when I first started in this business, we were doing Walgreens at 9.5 caps, which means someday we might get back there again, but we're not quite there yet. Anyway, I've gone through this a few times, this up and down cycle. Our team also is the first panel was talking about these DST structures, which are Delaware Statutory Trusts. So we are sponsors of those. We go out and we purchase properties and convert them into a DST structure, and then we bring in mostly 1031 tax-deferred exchange money into those. We use both the real estate market to find those investors, as I think someone mentioned earlier on the crowdfunding part, that we have relationships with a lot of investors that want to team up with us and buy into those as private clients. And then we also take some of their product, or much of that product actually, and put it out to the broker-dealer network, and then they go find us investors as our brokers selling pieces of those deals as DST structures. So pretty well versed in 1031 exchange, tax-deferred exchanges, and net leases. But I kind of wear two hats, even though I only have one head.
And we're waiting for Andy to join us via Zoom. He had the wrong kind of Zoom link. I see he's still in as a participant. So you gotta love technology. I thought we got the hang of this during COVID, but we're still this close. As you'll notice, the panel today, we've got a variety of different types of panelists, and hopefully this leads to a lively discussion about some of these topics. And we may bounce around a little bit from topic to topic, but hopefully each one of these people has important things to say about each of these things as we go along. We're going to start with Matt. And the question always is at these events, every single year, every single time, and especially in times of turmoil, what is going on with cap rates, what's going on with interest rates, and what is going to be the effect on the market?
Yeah, so, no secret, interest rates are going up. The housing market is the stuff in the news every day. People hear less about commercial real estate and the effects on pricing, but it's not rocket science. You're buying a spread, and I go back to a year ago, like literally 1 year ago today, the average interest rate out there for a 5-year fixed 25-year AM deal was 3 to 3.25%. Well, it was pretty easy to buy deals at 5 caps. And a 6 cap was a fantastic deal because you had almost 300 basis points of spread between your cap rate and your interest rate. So you had a ton of positive leverage. Well, what happens when your average interest rate today is 6 to 6.25? That spread is gone. So now there is no positive leverage on net lease deals. And if you look around in the market today, I mean, there's still, I'm closing on transactions still that are in the 5 cap range, and we have one that's in the 4s. But you're limiting your buyer pool to just cash buyers. So it seems pretty loud. But the moving forward, you know, because the cap rates, I think the interest rates have increased so quickly, commercial real estate is like a slow moving ship. It just takes a little time for things to react and adjust. And I think that we'll start to see just, you know, every month that ticks by, you can see that the cap rates on average are going up. So, and I think that's going to continue to next year. As the Fed continues to increase rates, you know, banks are adjusting. Everybody I talk to that's in the bank world or just kind of on the periphery says, oh, it's baked in. The next rate hike's baked into the rate. And
I was going to ask you that. Do you think it is?
I mean, kind of. I mean, because it's not, you know, I would say there's a correlation, but they're not directly tied to each other. But, you know, it's baked in until they give guidance that they're going to raise it again.
Exactly.
You know, and then they're trying to predict what's going to happen in the next one. So that's why they keep going up, because they keep trying to predict what the next meeting is going to bring. And I think until the Fed starts saying we're cooling off, we think we have a lid on inflation, and we're going to just hold tight. Once they do that, in my mind, that's kind of the bottom. Like, okay, now we've hit the bottom. Here's the new normal. People will now. I think that velocity will pick up a little then, because right now it kind of feels like if you don't need to act, why would you act if the price is going to be cheaper in a month? Or if you can wait 2 months, the price might be a little bit less, or the cap rate will be less. Now your interest rate will be up too, but so that's kind of my overarching thoughts for kind of the next year or 2 years. But I mean, there's still deals happening. I think the overall 1031 community out there, the 1031 buyers, just average kind of, if there were 10 buyers in the market to do a 1031 exchange like 8 months ago, I think today there's like 3 or 4. So that's a pretty drastic fall off, but I think that's roughly the numbers we're seeing today. And as far as like, you know, just overall pricing across net lease, you know, cap rates are all over the board, you know, depending on credit quality, lease term, location quality, all of that. But I would say on average, cap rates are probably up and pricing is down probably 10-15% on some assets, on some it's more. Others it's a little bit less. But is that a good summary for now?
Yeah, what I want to hear is, now I think you laid the groundwork for the big question is, what does it mean? If I'm a seller and I want to sell now, what are my options? Are people assuming debt? Is it possible to get an all cash buyer? If so, why are they even buying right now and not waiting, like you said? Just what's on the table? How do you close a deal? If you wanted to get a deal closed by December 31st, let's say, how would I do that?
Well, that's going to be hard, December 31st. You know, unless you're an all-cash buyer and you have attorneys like these two next to me doing the deal. I don't think you can get it done by December 31st. But I would say that I've seen this many times, and Matt, you're really talking about this gap. It's a perception reality problem. You know, the sellers have been babied for the last 8 years, selling at extremely low cap rates. Every year we would say, wow, I can't believe the cap rates have gone down again. And we'd be looking at this going, wow, I've never seen anything like this. And it kept going, right?
Well, that's right. I remember doing a presentation in 2018. It was 2018 or 19. And I made the comment that at the time, I think Starbucks were trading at like 5.25 or 5.5, and which is the lowest,
Right.
I mean, lowest they've been almost ever. And I said, you know, I think there's room to go lower.
Yeah.
And I remember somebody coming up to me afterward and said, I think that was an irresponsible comment.
Well, you must have seen a deal in California then, because
Yeah.
you know, that'll lead the way, and then all of a sudden, you know, it gets here, and you're like, we're in the 4s? Are you kidding me? We had some deals in the 3s, but I am seeing some repricing. I'm not going to mention we just went after a deal. In fact, just to kind of put this in perspective, you know, we're buyers, and so we can't really buy net lease deals right now with interest rates the way they are. So we're sitting around. I'll tell you what I'm doing right now, and I forgot to mention that. I'm going to seminars and webinars and working on my marketing, working on my website, because we're not buying deals at the cap rates where they're at right now with interest rates where they are, but they're starting to sneak up. In fact, we were looking at a really nice single tenant net lease deal in the Twin Cities here. I'm not going to mention the deal because we're still interested in it. And I just noticed that the cap rate jumped 25 basis points yesterday. And now if that follows and, we're still sitting in the weeds right now waiting, maybe another 25 basis points. And I think the broker is in the room right now that's doing this deal with us. So he's hearing me. We might be interested then because all of a sudden the thing starts to make sense. Because when we buy a property, not only do we have to buy it in cash flow, but we've got to reprice it so that we can put it out to the marketplace at a DST, which means there's structural restructuring costs and profit and all of that. And by the time we do that, there's got to be enough juice there. And I think we're getting closer, but it's not quite there yet. And so we'll just sit around and do marketing plans.
And hope the Fed doesn't say anything.
So Matt, I was going to ask you and Michael this. So the Fed can only control interest rates. And then the other piece of inflation, of course, is the supply chain issue as well as cost issue. So how is that? How are you able to factor that in as it applies to the cap rates?
Yeah, so, Jeff kind of touched on this a little bit, that, on net lease properties, typically the rent bumps worked into the lease, the initial term of the lease are somewhat light, and they rarely outpace inflation. In fact, you usually come up pretty short. If inflation is 6-7% right now, year over year, your average rent bump in a triple net lease is probably what, 1 to 3%, depending on the deal. Many national restaurant leases are 10% every 5 years. Some of the discount retailers are flat for 10 years, right, and then a 6% bump at year 11. So it's pretty light. So I think that's all figured in through, figured into the cap rate. So if your rent is going to be flat for the, a 10-year, 15-year term, well, your cap rate needs to be better going in order to account for that. So I think one kind of concrete example, Dollar General. Dollar General has flat 15-year leases, but they're absolute triple net. Dollar General's investment grade. They're excellent credit. But if you look at them, they're as good a credit as probably Starbucks. But if you look at the Dollar General cap rates versus Starbucks, right now Starbucks are probably 5.25, and DGs are probably 5.75 to 5.5, 5.75. Why is that? Well, the leases are flat, and the location qualities are typically the middle of nowhere.
And construction quality too.
And it's a Morton building,
yeah,
or maybe slightly better.
I think we've got Andy with us now.
That's right.
There he is. Can you hear us?
Excellent.
I can hear you. Thank you for your patience.
Miracle of technology. All right, Andy, we skipped you on intro. So can you just do a quick intro? 1031 intermediary, tell us a little bit about yourself and then what you're working on these days.
Well, I don't know anything about 1031s, but I did sleep at a Holiday Inn last night. So here I am. Excuse me. I'm battling the flu, so forgive my voice. I'm a business development manager for First American Exchange based out of Minneapolis here. I cover the upper Midwest for the company and their exchange services. I am new to First American. I joined them in July after about 20 years, nearly 20 years consulting 1031 exchanges, high net worth individuals, families, individuals that are going through meaningful exchanges. So I've seen sort of a lot of what these smart people on the panel with me are talking about. But now I sit in the role of a qualified intermediary, and it's been an interesting time to join First American with all the changes that you guys have just been speaking to, and the other panel was speaking to as well. So I'm grateful to be here and happy to chat.
Well, we're at the point in the agenda where it's your turn. So can you talk a little bit about what you see in terms of 1031 velocity, what you're seeing come across your desk, deals that are closing or not closing or falling apart or staying together? What's the current environment look like?
Well, we've seen a significant slowdown, as you guys have all been discussing. We've seen a significant slowdown, specifically on the residential side. Commercial, not so much. I think we're going to continue to see businesses sell and commercial properties transact. regardless of where cap rates are, business decisions are business decisions, and they have less impact, or I guess what my experience has been is that fluctuating interest rates tend to affect a little bit more of the common man. So we are seeing and anticipating a significant slowdown of residential exchanges. So that would be, the single family home rental and duplex, vacation home sort of rental properties. So yeah, we've been positioning for that. Where we've seen exchanges fail has actually changed too in my short tenure at First American. Prior to the summer, the most exchanges were failing because deals were being bought out from underneath exchangers. They would have identified 3 properties and they couldn't close on them fast enough, and they got bought out from underneath them. And of course, if they're beyond their 45th day, that puts them in a pickle, and they're going to fail their exchange. And now what we're seeing is just there's not suitable enough property for exchangers to get excited about. Why are they selling what they know to buy what they don't know? So we're seeing a little bit more hesitancy on the exchangers to even do an exchange because of what's out there isn't that appealing. And that's why guys like Michael and Matt too are so valuable because they give them options that they wouldn't have otherwise seen.
Cool. I didn't pay him for that, but I appreciate it. Thank you.
Yeah, you did, Michael. Yeah, you did.
Well, I think we had
You
on
just don't know it.
our notes too, Andy, real quick, if you could just talk about what is, of the things that are happening, what do the deals look like? Is there any particular deal type or investor type that's still busy in the 1031 marketplace right now?
Well, particularly, particularly in Minneapolis, we're seeing, for obvious reasons, we're seeing a lot of multifamily owners sell their assets and either go into completely different asset classes or more multifamily just outside the city with rent control and all the legislative topics that have been such a huge driver for that landlord type. Multifamily, I would say, is what we're seeing most of sell, transact, and most of whom are buying those assets are institutions. So, I always like to see what the institutions are doing, because if they're smart, and theoretically they're supposed to be the smart ones, my experience hasn't been that all the time, but it's fun to see what they're doing because they tend to be a little bit more out in front of it, and that gives me some warm feeling for the Minneapolis and St. Paul multifamily market, that they're still buying, even though they're buying potentially at discounts relative to in past years. They're still buying. And so we've seen, like I said, we've seen multifamily be an area that has been selling a lot.
All right, so Andy, feel free to jump in on any of the rest of the stuff. Just start talking. I can see you pretty well from here, but yeah, so just jump in when you have a relevant moment. Well, let's turn a little bit. Let's bring it back down to the net lease world for a little bit. We've talked a lot about 1031s, low basis, people that have tax problems or need to exchange. That's an important part of the net lease world, but just net lease in general. Now we're at a time where cap rates might be rising for the first time in my history, which I've been around this industry, Michael, 20 years. So, long time for cap rates to continue to go down and now to have them go up. But there's more to valuing a property than a cap rate. There's more to net lease than just thinking, what's the cap rate? So when you're kind of the net lease guru and you're advising clients either buying or selling, what are the important aspects in coming up with an appropriate value, especially when value is in question these days?
You asking me?
Yeah.
Well, first of all, cap rate is just one metric, and it's a baseline. So you can say, well, I'm buying this property versus that property, and I'm getting this kind of return versus that kind of return. And if you're not factoring in a lot of other things like hikes in rent, like you said, every 5 years you might have a 10% bump. If you have a flat lease, that looks different over that period of time. So that's not really cap rate, that's internal rate of return. And if you say, here's what I'm putting into this property, here's what I'm paying for my debt, and here's what I'm getting over that period of time for a return, and then I'm going to sell it in the future at some number, that all encompasses the way an investor really should be thinking, and that's called IRR. But there's other things that impact, the value of a property, and it's not just the income that's coming, the rent that's coming through, or the interest rate that you're paying, or the debt service that you're making, or that you're taking care of. It's other things, and I think the way I used to look at it, and I don't know how many times I've done this program, but maybe not 18 times, but maybe 15 times. And I like to look at it as a value matrix. It's kind of like a triangle or a three-legged milking stool. So there's kind of three major components in my mind that kind of make up the value of any piece of real estate, but especially a net lease deal. And so if you have this milking stool sitting there and you're sitting on it, if everything's perfect, if you got a great tenant with great financials, with long-term, rosy pictures, and they don't have any interruptions, they're doing great against their competitors, that's one leg. Another leg is the real estate itself. And we always talk about location, location, location. Well, that kind of matters. And you brought it up when you talked about the Dollar Generals having kind of inferior locations sometimes. I mean, they're sometimes way out on the sticks, and if they were to move out of that building, what happens? Or it might be a daycare property where, in the old days, they used to have these daycares where they have, several sets of restrooms in them with, little tiny toilets all over the place. And so what would you use that property for in the future? Restaurants have that same problem, and you guys are, being in the franchise world, probably see that quite a bit. But a restaurant building, if somebody was in there, the next restaurant that goes in there doesn't look at it the same way. They go, I got to blow everything out, start over. All I have is the bones here. So the real estate itself, ingress and egress, location, demographic profile, is it a very generic box versus not being a generic box? Those things kind of matter, in terms of value. And then the third thing is the lease. And this is, we did a bunch of deals together in the last couple of years, and you dig into these leases. And so, first of all, how long is the lease? How net is the lease? We talk about, you hear the word triple net all the time, and some people, I've not in this room, but I've seen people advertise properties as triple net. Well, it's a triple net lease, and then you go start digging into it. It's not really
with three asterisks.
Yeah. It's not really a triple net lease, meaning, it should be that if it's triple net, everything is paid for by the tenant. They pay rent, and they pay for all the expenses, and they pay for the upkeep, and they pay for the capital expenses, and they pay for the roof and the structure and everything. And all I'm doing is sitting on the beach getting paid. I just watch a little ding on my phone. Oh, more money went into my account.
Right.
That's the way a triple net's supposed to work. But
So,
then you dig
Michael,
in, and they're not. Yeah, go
what do you
ahead.
think, and
And that's the third leg. So,
historically, and then going forward, some of these leases that are not triple net, landlord's responsible for the roof, structure, parking lot. How are those viewed in the marketplace? How have they been viewed, and how do you think that they'll be viewed going forward?
Well, so going back to this, the perfect deal is the perfect deal. It's all of those things are perfect, okay? Most deals aren't perfect, so there's something wrong with them. But things like roof and structure are we're kind of common for a long time. We used to do a lot of deals where roof and structure was the landlord's responsibility versus the tenant's responsibility. So we'd factor in some money that we set aside, some reserve cash that you take out of your cash flow, put it aside so you have to deal with the roof at 15 years or 10 years or 20 years or whatever it is. But there's a lot of things in there, I think, that are kind of taken for granted. People build buildings now that are high quality. If it's a brand new building, you don't really have to worry about the structure of the building typically, but you're going to have a roof problem at some point. And so those things are kind of baked in, and I think we see that kind of come out of the cost or the pricing. The cap rates are adjusted accordingly. But the hidden stuff is what I think people don't really understand.
Right.
And that's where you guys have saved some of my clients and us.
Yeah, you do look at the language of the lease, and there are certain things that terms that are not triple net, and so maybe we can go into that discussion a little bit. I think I'll let Vicki give it a go from the beginning, and then we'll.
Sure.
Yep.
Obviously, this is one of the things that we look at when you're evaluating, let's say, multiple properties on a 1031. You've already identified them, or you're in the beginning stages of selecting some for identification. We'd like to take a look at that lease. Is it really a triple net lease as marketed, or are there these hidden costs that In the event that that's the property that you select, there may be some costs that you're going to have to, you as the landlord, the fee owners are going to have to eat because you can't pass them through to the tenant. So I think lease evaluation is really important as a part of these transactions. It doesn't, the 1031 exchange doesn't stop at the identification stage. You really need to evaluate the leases as well, if you can, before you even get to that point, so that you can determine on a comparison basis of one property to the next, yes, this looks like a really great deal, but if you look at the lease, there's these hidden costs that you're going to have to pay. And that's going to affect the economics of that transaction. And maybe that's a site that on paper, if it looks great, when you dig into it, may not be the property that you want to go for it because it doesn't match your goals.
And not only the cost of it, but just the dealing with it. You know, I said, I kind of want to lay on the beach and see the ding on my phone, and that's all I want. That's the perfect thing. But if you have to deal with, you know, I remember we had a ingress and egress, or it was a road that we had to take care of on a property down in Florida. Perfect deal. Everything else was great. And all of a sudden we're getting harassed by the owner of the adjacent shopping center that we have to take care of the road. And it was deep in the lease.
Right. And then that's something that we've talked about. There, shopping centers or parcels on shopping centers, you need to look at both the lease and then the underlying documents to see what kind of responsibility are meted out to each of the fee owners. Now, hopefully in your lease, there's a provision that says, you know, tenant takes care of everything, including any charges under any reciprocal easement agreements and so forth. But again, in a tenant, as it has been a tenant world, there may be a cap on the amount of increases that the tenant will bear. And so there may be a gap in there between, you know, what is being charged and what is, you know, what is being charged to the landlord and what the landlord can pass through to the tenant. So I think those things are important.
And I think the thing to think about with regard to some of the tenant negotiated cap on CAM increase rates for a landlord, potential buyer to think about is, in doing so, in the tenant negotiating that lease and wanting that stability with regard to increases, there may be a commensurate increase in what the per square foot rate was for that property. So a person looking at that lease may say, well, I've got a lot of hidden costs here. You also then need to look at your rent rate, because it may be a little bit above market, and then that's the money then that you're putting aside to pay for those hidden costs.
Yeah.
So
Hopefully, may I add something? Hopefully the taxpayer has Vicki and Pat doing the lease review, and will have enough time within their 45 days to sniff out any issues with the lease. But I think it's really critical that sophisticated exchangers understand the 200% rule as a purpose of backing up properties that are on their form that may come up with some issues after the 45th day. So understanding the 200% rule is really critical for exchangers to make sure that they're not going to get stuck and be forced to pay taxes just because they didn't understand how to utilize that particular identification strategy.
Yeah, Andy, I think that's a really good point. And I'll ask Matt and Michael, what do you think in the 45-day process, do you like to have the potential properties under contract, or you identify them and then put them under contract, or a combination of the two?
You'd like to have them under contract.
Yeah, so then if you go with the 200% rule, you may have some values that are, some properties that aren't, you may not be able to, that you're ultimately not going to buy. So there's cost involved with getting each of those properties under contract.
in my experience, it is difficult tying up multiple properties with the intent of purchasing only one. Typically, if you're representing a buyer or working with a buyer, or if you are a buyer, if you're working with on a deal that is being represented by, I would say, a decent listing broker, most of them will poke holes in your story and ask, hey, how many properties do you have tied up right now?
Right.
I mean, it's a pretty simple question. Okay, you have
But
three.
you don't answer it with just a number.
Yeah, you say, you know, I have a couple things I'm looking at right now,
Yeah.
you know,
This
but
is their favorite one.
Yeah,
yeah,
You're
but
the, you're the queen of the prom.
right.
But, you know,
right.
when I'm making those kind of vetting questions or asking those questions, I mean, you know, people are going to give you half the answer. But it does become difficult because if they hear that, hey, you're pursuing multiple properties, you have, you know, a couple under contract, or you have multiple offers out there, well, you're probably going to start moving down the list of priority, you know, if there's multiple bidders on the table. I think that, you know, we are entering a market now, where there's, I mean, I mentioned before, if there were 10 bidders on the table before, 1031 buyers out there in the market before, there's 3 to 4 today. You know, that's a lot less bidders on the table and a lot less competition. A year ago, if you had a Starbucks that you put out of the market, the thing would probably sell in about 15 minutes. And that, you know, today, using just kind of comparison numbers, if there were 10 Starbucks on the market at any given time, 8 months to a year ago, there's like 30 on the market today because they're just starting to sit a little bit longer.
So the listing brokers don't have as much clout.
Exactly.
I mean,
So I mean, there's more room to flex as a buyer. You can probably negotiate longer due diligence periods. So if you were going to tie up multiple properties, or try to have, or maybe even try to close on 2 properties, you can try to time them out to work together. So you can probably, like I said, the buyers have a little bit more leverage now and can, you know, negotiate a little longer time frames and just a little bit better deal terms.
One of the more powerful backup identifications that I've seen clients use both in my prior occupation as a consultant and now as a QI, it was alluded to by Dan, I think in the prior panel, Dan Werry, where there are financial vehicles, and they are financial vehicles. They're not really even real estate vehicles. They're a DST structure that allows the clients or the taxpayer to extract 85 or 86% of their cash out of their exchange tax-free. And so sometimes what we'll see exchangers do is, whether they utilize the 3-property rule or the 200% rule, they'll utilize that asset on, or that financial tool as one of their identifications, so that if both other 2 or multiple deals fall through that they've identified, they at least have the ripcord of, I'm going to exchange into this highly levered DST that allows me to extract my cash out, sit my cash on the sideline, and then give that cash to Matt, for example, and without the stringent 45, 180 day time frame anymore, Matt can go find me something in the time that the market dictates, rather than what the IRS tells me I have to buy the property within. And I'm doing it at a brand new basis because I'm investing cash. So there are, I don't want to say parking lot strategies, but I have seen that financial tool that Dan was talking about used pretty strongly as a backup, sort of a safety net ripcord feature on identification.
and I would say this, just looking at, okay, so first of all, from the DST sponsor side, we'll tie up pieces of a DST with investors that are coming in with 1031s. We know they're looking at other options, but it isn't so bad being the backup, because we get some of those deals because they'll find something wrong in those leases or in those contracts, and they can't make that deal, or through their due diligence, they find problems. And being the backup, it's all ready to go. I mean, a DST has financing in place. All of the due diligence has been done. It's been vetted by the bank. It's been vetted by us. It's been vetted by, and we have property condition reports, environmental reports. Everything's pretty much done. I mean, if you wanted, seriously, I think, Amelia, you're sitting right here. We can close a DST in 48 hours, 24 hours. Yeah.
So,
Well, what I was going to say though, on a normal deal, and this is what the beauty of a net lease, and this is a net lease summit. The beauty of a net lease is that it's a single tenant, long-term lease typically, and it has very few moving parts. It's that you're not looking at a rent roll with 14 different tenants in there with things that are moving around. You got to determine if there are all of these different things about that property. It's pretty simple. And so really you should be able to get through DD quickly. If you have good attorneys that are working on it. I mean, I don't know, we did 8 deals in like 60 days?
yes.
It was
and
fast.
It was.
furious, but you're looking at kind of the same stuff.
Right.
So you just got to get on it and get going.
And
Can't
then-
sit around.
Yep, and then going back to some of the elements of the lease that you should pay attention to. So I took an excerpt of a supposedly triple net lease. And so the obligation of the tenant to pay real estate taxes is qualified by, nothing, if the landlord actually pays the taxes, tenant doesn't have to pay penalty, no personal taxes. But in this case, they also added that the tenant is not responsible for real estate taxes attributable to a change in ownership of the premises. So and again, it's a little buried in there. So in this case, the state that this property was in, we did some analysis and we weren't as concerned about the price being jumping. But if you're in a jurisdiction where the valuation is based on the recent purchase price, then in this kind of language in the lease, that's another hidden cost that I think you need to kind of vet out, and I think it's becoming more and more popular, that term, in the last couple of years. So as you're looking at these leases, you want to just make sure that something like that isn't in there.
Add one, just kind of a overarching thing on those kind of lease terms. I would say that, when you're looking at the better the credit quality of the tenant, I think the more necessary it is to look at the lease really closely.
That's a really good
because,
point.
the whole reason that those tenants, those really strong, big time national corporate credit, investment grade tenants, the reason they can flex on lease terms and come up with some pretty creative things is because a lot of people gloss over them because their cap rates stay really low because the quality of the tenant is so good. And, so it has less of an effect on the cap rate if they put some creative things in there. Whereas, when you get into the smaller tenants,
and they go into dynamite locations with great buildings, so you don't think about that, and then all of a sudden you realize they wielded a hammer, and you got a double net lease.
Yeah. If you have the backstop of fantastic real estate, if they take some liberties with some of the leased clauses, it's okay. But the little guys, some small franchisee or small, Joe Blow tenant, you can hold their feet to the fire because you say, hey, I'm going to go get whatever better tenant, and if you fight me on this.
So one of the other things to look at in the lease is the ability of the tenant to terminate the lease. And it's not always, if the landlord's in default, tenant can terminate the lease type of language, but you need to look at your condemnation provisions, your damages and destruction. Some of the provisions state that if it's in the last 2, 3, 5 years of the lease term, then the tenant has the right to terminate on a long-term lease, or if there's a damage and destruction during the period of during the extension period. But I was going to ask Andy, if you're a landlord and the property is you have a property that all that's left is basically the dirt. How does that work as far as, can you take the insurance proceeds plus the value of the dirt and put that into an exchange, or so that you don't have, just a cash issue?
I don't know that I know the answer to that. Let me understand. There's an insurance payout.
Yes.
As a result of a condemnation, or?
Well, yeah, I think it applies to both. It's either condemnation or damage and destruction. Condemnation, of course, you get the proceeds from the condemning authority. But I guess, and maybe it's too obscure of a question, but if you own a triple net property, a Burger King, and the Burger King burns down, or part of the drive-through is taken so that you can't operate it as a Burger King anymore, so the tenant has the right to terminate. So now, with respect to a damage and destruction, So the landlord still owns the dirt and gets the insurance proceeds because the tenant has terminated the lease. What, how does that play into if you want to exchange into another property? Can you put in the insurance proceeds as part of your exchange?
I wouldn't think so, but I really don't have an answer for that. I don't know that you would want to. I don't know that those proceeds would be taxable, so I don't know that you'd want to tie them into the tax strategy of an exchange. I think the
Sure.
taxpayer may be better off keeping them out anyway.
Right.
I don't know, but I can certainly get the answer.
And I think that dovetails into another discussion with regard to thinking prospectively, what's next for this site? If you have a Dollar General, or if you have a Starbucks, when you're acquiring that property, you not only have to think about what's going to happen now, what's going to happen during the term of this lease, but what's next? What else could this site be used for in the event that that particular building burns down and you're going to rebuild? What can you marketably put into that property, which is also an opportunity. If you think about the fact that you now have an opportunity to take what might be a non-market lease with regard to certain terms, create a very landlord-friendly lease, true triple net, that is now going to be marketable on the 1031 market. So just thinking prospectively about location and building type and what's next for that property is also something to think about with regard to when you're doing that initial 1031 acquisition.
And then just if you have a franchisee who's your tenant, there are things that you need to consider as well. Usually the franchisor either requires that the lease be assignable to the franchisor in the event that the franchisee defaults, in which case the franchisor can step in and step in the shoes of the tenant without the consent of the landlord. So now the good news is hopefully the credit is stronger of the franchisor than the franchisee. But the part to be careful of is oftentimes the franchisor then has the right to assign the lease to another franchisee who may not meet your standards that you put for a qualified assignee. So if the landlord in your assignment and assumption language, I think you can put in there kind of define what type of franchisee is acceptable. So, a certain level of experience, net worth, liquidity, those types of things, that can be in the language of the lease. Now, if the franchisor has the right to step in, they may not have the obligation to meet for their assignee to meet those metrics. And a lot of times the franchisor then, upon assignment, they are relieved of the responsibility under the lease. So, and we've had mixed ability to negotiate as landlords some of those provisions. Some franchisors are, nope, this is these are the terms I want. We have to get notice. We have the right to come into your property and de-identify, and to kind of takes those steps. And so it may be that it's a McDonald's franchisee, and that's good news because it's a strong credit. But the franchisor for McDonald's, it's been a long time since I've read their it's kind of a tri-party agreement, but is what their step-in rights might be.
And just to follow up on that, obviously, getting a copy of that tri-party agreement or that lease rider as a part of that lease evaluation is obviously important, because that's another player then that you have to evaluate who's coming onto your property. What can they do when they come in to de-identify? Who pays for any damage that's caused? And how is that relationship going to work? For example, in the de-identification process and with regard to assignment and subletting.
We had years ago, we had a Pizza Hut, the old red roofs, that was de-identified. It was in Iowa somewhere. And so they had to take the top part off. somebody smarter than me knows what that's called. But then they ended up, the unit looked like a Pizza Hut without that little top part on it. So, and then they have to spray the roof so it's a different color. Well, how well do they have to do that if the property's vacant for 6 months and that paint starts to chip away? That can be problematic. But I think the bottom line is that a lot of these franchisee leases are good, maybe for individual and not institutional leases. But in any event, I think it's if you have a franchisee tenant, you have to ask for what are the franchisor step-in rights.
And adding to that with the effect on pricing and cap rate, I mean, that assignment language and the franchisee size has a direct impact on pricing. And I mean, 2 concrete examples of that. If you look at Starbucks across the country, I'd say the cap rates are there's continuity, amongst the cap rates because every Starbucks lease is corporate. And I haven't come across, I think, any that have assignability clauses. They're all corporate. Now, flip side, Burger King that we brought up, if you look at Burger King's, the cap rates are all over the board because you have franchisees that are 5 units out there, you have corporate deals that are out there, you have 10-unit operators, 50-unit operators, they're all over the board. And within each one of those leases, there's also varying assignability clauses where they could assign it to a franchisee that has a $1 million net worth that's just a person. And or they have an assignability metric where it has to be a minimum net worth of like 10 million or 20 million. And you'll see that all reflected in the cap rate. So I think, just the boiling it down to like a theme there is just like, you got to know who you're dealing with. And I mean, and it does have a direct effect on the pricing. So it's important to review.
I think another piece that we should take a look at is whether or not whether the tenant has the ability to go dark. So as a tenant attorney, I would say if I'm not paying percentage rent, so long as I maintain the premises and keep paying the rent and all other charges, as long as I'm otherwise in compliance with the lease, I should be able to go dark to cut my losses or to try to then market the property. Many landlords, though, they don't want a dark box, which is understandable. So that's something you need to look at, and then if your tenant does go dark, then see if they have the right to go dark. And we had a case where a franchise restaurant went dark, but there was a no-go dark provision, and the landlord was adamant about enforcing that provision, but there wasn't term left on the franchise agreement. So vis-a-vis the franchisor, they could go dark, but with respect to the landlord, they couldn't. And so we ended up having to buy out that lease. So there are things kind of embedded.
Sure, and in that go dark situation, obviously you still want to make sure, if you're Michael and you're sitting on the beach and you're happy with making sure that phone ding deposit is still happening.
Michael.
You also want to make sure that tenant is still maintaining the insurance that they're required to maintain and making sure that property is still secure. So even in a go dark situation where the pings are happening on your phone, you still need to make sure that those other obligations of the lease, non-monetary in nature, are still being followed.
So just one last thing on the leases, just coming out of COVID. So during COVID, as most people know, there was either rent deferral, there's some rent forgiveness, but in some lawsuits that alleged that, hey, it's an impossibility of performance or a government shutdown, and so the tenant would be excused from paying the rent. That has pretty much gone nowhere, especially if your force majeure clause, if you're relying on that, it says that yes, you can shut down, but nothing that happens in essence will allow you to affects the payment of rent and other charges under the lease. So I think that the best thing that if there's another incident like that, my advice to tenants, contact your landlords right away so that you can come up with a joint plan on how to handle this disturbance, from normality.
And Pat, aren't they, I mean, I'm glad you brought that force majeure up. When that happened, a lot of landlords said, oh, we got to start looking at this. And so they started to add another clause into the lease to make sure that they're going to get paid whether there's a pandemic or not. And I think that's kind of interesting. That was just a complete switch. Never saw it in a lease before, and, papered over the force majeure.
How many people had talked about force majeure more than like one time a year before COVID?
But I think that, I was thinking about, Vicki, when you were talking about, the future use of a building. And this is going to age me, but probably many people in here remember when there were all kinds of video stores all over the country. Blockbuster Video, Hollywood Video, Video Update, and they were all over the place. And they were generic boxes, 6,000 to 7,000 square feet, rectangles. I had a client that bought a few of them, and then, video industry went away as predicted, and he was happier than heck because both those three properties got released to Starbucks. Super happy about it. So I think the thing to remember is that not only does it have to work now, but it has to work in the future. And it goes back to just that stupid little matrix I use, or that little milking stool. Is there's three parts of this thing that actually drive value. It's the tenant, it's the location and the real estate, and it's that lease. And now you get, when you get deep in that lease, it can mean a lot in terms of value. I mean, we discount or we don't buy the property because of it. And the seller gets it, runs into that 3 or 4 times because smart attorneys find the problem in the lease. The next thing you know, the thing's discounted and it's selling at a much different cap rate than what they thought they were going to get.
All right, we have covered the content we promised we would cover, except for one thing, and that's one of my favorite topics in Net Lease, is who are the current darlings? Like, the people in this room, it's that time of year where we're starting to think, 2023, what am I gonna do in 2023 if I'm in the Net Lease industry? And I'm feeling like it might be a slowdown. What are the things that are gonna trade or get developed or happen? What are the things that are?
Can I throw one more part into that question? Because I think it's amazing to me that this has happened. In about a year, we never hear the word essential real estate anymore. I mean, it was like the thing. Everything was, it has to be an essential piece of real estate. They're going to stay open. The pandemic isn't going to affect it. I never hear that anymore. But what do you think about that?
Every marketing package I reviewed for a year had COVID proof, or with an asterisk, COVID resistant, pandemic resistant, and everything was essential business. And you're right, I haven't heard that at all this year. Hasn't mattered.
Disappeared.
So I guess kind of looking forward at what are the the businesses, the darlings. I mean, we've talked about Starbucks a lot. I mean, they're kind of a gold standard out there. I think they're just between their credit quality, the general quality of their locations, there's a lot of them. They're trading a lot, so it's just easy to track. They're still trading at some of the lower cap rates out there. Chick-fil-A still sees some of the lowest cap rates out in the market, along with newer McDonald's, although we don't see as many new McDonald's anymore. But Chick-fil-A has been pretty active. I know Raising Cane's is still really active. So anything QSR and coffee, I think that's going to continue to be big because they can pay the freight. They can pay up for big sites for quality corners, and they don't need that much dirt. So from a developer standpoint, they make a lot of sense. They're a high margin tenant, or can be.
And to investors, they're bite size. I mean, they're not $15 million.
Exactly. The price points, they're anywhere from $1.5 million to $3 million, which is a great exchange number, because you think about it, if you're selling out of a 4-unit and you've owned it for 20 years and you own it cash, and you're selling it for $600,000, well, you could put 35% down on a deal and get into something for $1.5 million.
Yeah, just to add to that, I think, as you mentioned, QSRs, Taco Bell is for the last 3 or 4 or 5 years has been a very hot property, and looking into a recession or economic slowdown, they're positioned pretty well because they don't have as much food cost. And so they can kind of moderate their prices a bit. So I think that's been one of the things we've seen a lot of activity in the last 18 months are car washes. And I think that the car washes, my first instinct was, well, I can't develop these in California because it's going to be so expensive. Water, what's the issues with water? But I think that and somebody might know this better than I, but with the new technology about being able to recycle water and has cut down on the draw of the water. So I think that's helped a lot. But, I don't know if you guys have seen that jump.
Yeah, we actually work with a couple we're working with one right now, trying to find sites. The hard part is not in my backyard. Nobody wants them.
Yeah.
And yet,
None of the cities want
yeah, none of the cities want them, and yet the people that live in the cities want them because they want to go to a nice car
Right.
wash. And so they're trying to counteract that with really nice looking product.
Mhm.
Drive by one, they don't look that bad. They have great sound, like sound attenuation,
Yep.
all of that. And I don't know, I just think they're a hot commodity. I don't know why they boom so much. I mean, just out of nowhere. I mean, I was thinking about this question.
We can't hear you very well.
Oh, sorry. I was thinking about this question today, and I actually was gonna blast something up on the screen and give you a slide, but another thing we're seeing a lot of is daycare centers and, or childcare centers. And, they become, and also convenience stores. Convenience stores are booming all over the country, and big name brands and even smaller name brands that are starting to, elbow their way into that space. And then and we don't have time to cover that, but with that bonus depreciation or the accelerated depreciation that came along in that Jobs Act, people can invest in those things and they get even a better return because they can take advantage of that sometimes. And so I think that's important, and maybe you can speak to that, Todd, because you know that part a little better. But convenience stores and things with high levels, oil and gas type properties is what really comes down to. Why don't you talk about that?
Yeah,
just
the
a second?
people in this country that are looking desperately for depreciation are gobbling up things that bonus depreciation applies to. And the math is unbelievable. Every penny you put into the property of cash, now you have to lever it up to make it make sense, but if you put an appropriate amount of cash in, you're getting that much in tax savings, which that's never happened in the history of since the beginning of time, as far as I know. So that's an interesting conundrum for those particular assets.
Gas and C stores, you also have to be, or C stores with a gas station, you have to be careful of environmental issues. So, for example, in Minnesota, the landlord does not want to own the tank because the liability follows the tank. So you'd want to make that clear, or at least find a way to, if it's not in the existing lease, just have a record for yourself that, the tank ownership lies with the tenant.
Leave it to the lawyers to find the two women.
Love those deals.
No, just protect yourself. Just
right.
protect yourself.
I think that the drive-through is not going away anytime soon, if there's anything that we've learned from the pandemic. And also this convenience of pickup, having parking spaces where people can just come up, have someone have already selected all their items and just put it in their car. That's not going away. That's now being seen as a positive. And I think, and not necessarily associated with a pandemic, that's a convenience that I think a lot of developers of property and designers of layouts of property and site plans are taking into account, and that we're going to continue to see that in the future as well.
Yeah, we worked with the Buffalo Wild Wings Express client in Florida, and they had an end cap of a shopping center, and they asked for and received permission to put in a walk-up window on the side of the building, so that if the inside's closed down, they can still, or if the other issue, and it's a whole different topic, is if you don't have enough employees, keeping these stores open, whether it's a Dollar General or a Chick-fil-A, is dependent on employees, and there's still a big issue getting people into work.
Well, we are past time, so if you're here for CE, the sign-out sheets should be out. I'm going to still give these people time to talk, so if you want to open up to questions. But if you do have to leave at exactly 10:30, the sign-out sheets should be out there. Does anybody have any questions for the panel? Things that they're curious about, want to know? Build on? Quiet group? Okay, is there anything we missed that you all said, you know what, if I let people go right now and I didn't say this?
You know, the only thing we didn't really cover that we had on our agenda was guarantees. So and I'll just make a brief comment and then you guys can approach it from a market standpoint. Representing a tenant, you want to see, if you have to have a PG, you want to have a burn off of some sort on that personal guarantee, whether it's after the first 5 years, if you hit certain sales figures. So I think those are different ways that we've been able to, help a tenant kind of reduce their personal liability, but I'm not sure what that looks like in the marketplace.
I would lump it into kind of the assignment clause and even to some degree like your termination clauses. The way the market perceives personal guarantees is once it burns off, now it's a single purpose entity and they could just, BK that entity and kind of go away. So we find that, personal guarantee deals with burn off times. Typically the cap rates are a little bit higher. So again, I kind of lump it under the umbrella of review the assignability clauses and who the actual tenant is, kind of like a franchisee.
Yeah, then there's corporate guarantee, versus personal, and personal is harder because you actually can't go after some of the assets that they have. If things do go bad, you can't take the house, you can't take certain assets, and so when you start looking at the financial credibility of that tenant, there's sometimes not very much there. So it's from the marketing standpoint or the market standpoint, they looked at it with kind of a jaundiced eye, I think.
Yeah, and I think the other thing to think about with regard to those corporate guarantees is making sure that you're getting the mothership with regard to who that corporate guarantor is, and making sure that it's not just an empty shirt.
100%. Good luck, though.
Yeah. Andy, you got anything to add over there?
I would just reiterate the understanding what the 200% rule is in the event that you as an exchanger are going to consider a multiple replacement property exchange. You can use the 3 property rule if you need backups for the one deal that you're targeting. But when you start with larger exchanges, when you start diversifying into replacing your relinquished asset with multiple properties, you really need to understand the 200% rule. So that you can utilize all that the IRS gives us to protect yourself for backups, so that you're not forced to pay tax that you would have otherwise not wanted to.
And I think it's kind of come through besides understanding the value of the piece of real estate through those 3 facets that I said, you have to get on this early. There's a lot of work to this. And I can't tell you how many people have called our office at the end of their ID period because they look at something, they're going to buy it. Everything is it's like we used to have this saying, somewhere in America, it's someone's day 45. And that's where you get a call. Hey, can you help me with this? Like, really? It's Friday night, and sometimes you scramble and you can help them, but really you want to get on it much sooner, have the time to do your due diligence, use the attorneys to dig into those leases and the related documents, and have a broker have the appropriate amount of time to go out and find options, because there's other people looking at the same properties and you can't tie them down as easily as you think. So go early.
Good advice. We've seen it all at this point, right? Okay, thank you everybody for your time. Andy, thank you for your patience on the tech. And thank you to all of you for attending today. Look forward to seeing you all next year at the same Net Lease 1031 conference.
Thanks. Thank you, everyone.
Thank you.